Welcome back, everybody, for another deep dive. This time, we're going to be taking a look at technical analysis.
Okay.
You guys gave us some really interesting stuff to dig into this time.
Yeah.
But one book in particular really stood out to me.
Okay.
It was called Evidence-Based Technical Analysis by David Aronson.
Oh, yeah, I've heard of that work.
Published in 2006.
Yeah.
But what really caught my eye was this whole idea of, like, separating the fool's gold from the real market insights.
I like that.
When it comes to, using charts and patterns and so on.
Right.
So I'm ready to dive in. How about you?
Absolutely.
Okay, so first things first, like when we talk about technical analysis.
Yeah.
Most people think about, just charts and patterns.
Right.
But Aronson argues that it's actually like a much deeper, more scientific approach.
Absolutely. I think that's one of the key takeaways from the book.
Okay, so let's unpack that a bit.
Sure.
What does it even mean to take a scientific approach to technical analysis?
Well, think about it this way. If somebody tells you that, they have this amazing trading system.
Yeah.
That's based on, some like secret chart pattern.
Okay.
How do you even like verify that?
Right. You can't.
You can't.
It's just like taking their word for it.
Exactly. And that's like the problem with so much of what's out there,
Yeah.
It's all subjective, untestable. And ultimately, as Aronson puts it, it's meaningless.
So it's like going to a doctor and they just diagnose you based on a hunch.
Yeah.
Like they don't even run any tests or anything.
Exactly. You wouldn't be very confident in that diagnosis, would you?
No, not at all.
And that's where the scientific method comes in.
Okay, I'm starting to see where you're going with this.
Yeah, so the scientific method is all about demanding evidence, testing your assumptions, and being open to being wrong.
Yeah, that last one can be tough.
It is, but it's essential.
Okay, so I get how like this scientific mindset is important in general.
Yeah.
But how does it actually play out when we're talking about like, trading and technical analysis?
Well, it starts with defining very clear, objective rules for your trading strategies.
Right.
None of this, vague, like, buy when it feels right stuff.
Yeah.
You need, like, specific criteria. Like, okay, buy when the stock price closes above its 20-day moving average.
Yes, something you can actually measure.
Exactly. Something you can test. Something you can backtest and actually see if it holds up.
That makes a lot of sense.
Yeah.
It takes the emotion out of it.
It does. Which we all know can be pretty tricky when you're watching the market move.
Oh, yeah, for sure.
Fear and greed can really mess with your head.
Big time.
Yeah.
So, okay, we've got these objective rules.
Right.
Now what?
Well, now things get really interesting. This is where we can start using data mining.
Data mining.
Essentially letting computers sift through massive amounts of data to try to find profitable patterns.
Wow, that sounds super powerful.
It is, but it's also dangerous if you're not careful.
How so?
Well, you can imagine if you look at enough data, you're bound to find something that looks good.
Right.
Just by chance. Exactly. It doesn't necessarily mean you found a real edge. It could just be random noise.
Oh, so it's like flipping a coin 1,000 times.
Yeah.
Eventually, you'll get a long streak of heads.
Right.
But it doesn't mean you have some magic coin.
Exactly. That's what we call data mining bias. You have to be very careful about that.
Okay, so how do we avoid falling into those traps?
That's a great question. And it's something that Aronson addresses in his book.
Okay.
He talks about something called White's reality check.
White's reality check.
Or WRC for short.
Okay, what is that?
It's basically a statistical test
Okay.
that helps you determine if the results you're seeing are truly significant
Got it.
or if they're just a product of that data mining bias we were talking about.
So it's like a way to filter out the noise and make sure you're not fooling yourself.
Precisely.
Okay, so if we have to be so skeptical of subjective technical analysis,
Right?
and we have to be careful with data mining too,
Yeah.
where does that leave us?
Well, it leaves us with the challenge of developing more sophisticated evidence-based approaches.
Okay, I like the sound of that.
And that's where Aronson's case study comes in.
His case study. Okay, tell me more about that.
Sure. So he took this whole idea of evidence-based technical analysis and put it to the test.
Okay.
He focused on the S&P 500 index.
Okay.
And he used a huge amount of historical data.
Okay.
And he tested thousands of trading rules.
Thousands. Wow.
Yeah, he really went all out.
So what kind of rules are we talking about here?
Well, he looked at a variety of different approaches.
Okay.
Things like trend following rules, trying to identify extreme market conditions, even comparing stock prices to bond yields.
Wow. So like everything but the kitchen sink.
Pretty much. He wanted to see if there were any statistically sound patterns he could exploit.
Okay. So what did he find?
Well, here's the thing.
Yeah.
None of the rules he tested, even after accounting for data mining bias,
Okay.
produced returns that were statistically significant enough to be like, truly reliable.
Oh, so none of the rules actually worked.
Well, it's not quite that simple.
Uh,
I mean, some of them showed promise in the historical data,
okay.
but none of them were consistent enough to bet the farm on. And
So it's not like you found some magic formula.
no, definitely not.
So should we just give up on technical analysis altogether then?
Not at all. I think his findings are actually incredibly valuable
How so?
because they highlight the dangers of relying on simple, off-the-shelf trading rules.
Oh, what?
You can't just blindly follow some indicator or pattern and expect to get rich.
Right.
It's a call to action for technical analysts to get more creative, more innovative.
So it's not the end of technical analysis.
No.
It's just the beginning of a new, more rigorous chapter.
Exactly.
Okay. I like that perspective.
Yeah, I think it's a really exciting time to be involved in this field.
Okay, so let's dive into some of the specific types of rules that Aronson tested in his study.
Sure.
He mentioned trend-following extremes and something called divergence.
Right.
Can you walk us through each of those?
Absolutely. So let's start with trend following rules.
Okay.
This is probably the most intuitive concept in technical analysis.
Yeah, buy when the price is going up, sell when it's going down.
Exactly. But of course, defining a trend objectively is a lot harder than it sounds.
Yeah, I can imagine. There's a lot of room for interpretation there.
There is, and there are tons of different methods and indicators that people use.
Okay.
Aronson tested a variety of trend-following rules
Okay.
using things like moving averages, channel breakouts, and even something called Alexander filters.
Alexander filters. I'm not familiar with those.
They're also known as zigzag filters.
Okay.
And they're designed to kind of smooth out the price data
Okay.
and help you identify those key turning points in a trend.
So it's like filtering out the noise and focusing on the bigger picture.
Exactly.
Okay, so that makes sense. But did it work?
Well, like a lot of the rules he tested, some of them showed promise in the historical data,
Okay.
but none of them consistently beat a simple buy and hold strategy.
Oh, wow. So even with objective rules and fancy indicators,
Yeah.
trend following is still tricky.
It is.
Yeah.
And it highlights the importance of things like risk management and position sizing.
Right. Even the best trend following systems will have periods of drawdown.
Absolutely. You have to be prepared for that.
Okay, so trend following, more nuanced than it might seem at first glance.
Definitely.
What about those extreme and transition rules? What are those all about?
So those are based on the idea that markets tend to swing between periods of being overbought and oversold.
Okay, kind of like a pendulum.
Exactly.
Yeah.
And the goal is to try to identify those extreme points
Okay,
and capitalize on the potential for a reversal.
so you're still trying to buy low and sell high,
Right.
but you're using technical indicators to figure out when the market has gone too far in one direction.
Precisely. Aronson tested a bunch of indicators that try to quantify those extremes.
Okay, like what?
Things like channel normalization,
Channel normalization.
which looks for deviations from a stock's typical price range. So it's basically like finding the outliers.
Yeah, you could think of it that way.
Okay, so did it work?
Well, again, like the trend following rules, some of them showed promise in the historical data,
Okay.
but none of them produced statistically significant results after accounting for data mining bias.
So even timing those market swings is tougher than it looks.
It is. It's a very challenging problem.
What about the divergence rules? What are those?
So divergence rules look for situations where the price action of a stock might not be confirmed by other indicators.
Okay, can you give me an example?
Sure. So let's say you see a stock making new highs,
Oh.
but a momentum indicator like RSI is actually showing weakness.
Okay.
This could be a sign that the trend is about to reverse.
Interesting. So it's like a crack in the foundation of the trend.
Exactly. You're looking for those subtle hints that something might be changing.
Okay, so did these divergence rules actually work?
Unfortunately, no.
Oh.
Just like the other categories, some showed potential,
Mhm.
but none of them held up under rigorous statistical testing.
So it seems like even the most sophisticated technical analysis strategies need to be approached with a healthy dose of skepticism.
Absolutely.
It's a reminder that the market is constantly adapting and evolving.
It is, which makes the quest for reliable trading strategies all the more challenging.
Okay, but it's not impossible, right?
Definitely not. I actually think Aronson's work points to some very exciting possibilities.
Okay, I'm intrigued. What makes you so optimistic?
Well, remember, his study was limited to a specific set of rules and indicators.
Okay.
There's a whole universe of potential strategies out there.
Right.
I think his work is more of a challenge to think differently,
Okay.
not a reason to abandon technical analysis altogether.
So it's less about throwing out technical analysis
Yeah.
and more about evolving it.
Exactly.
Okay, so how do we do that? Where do we even begin?
Well, one key area that Aronson highlights is the concept of rule complexity.
Rule complexity, okay.
The rules that he tested in his study were all relatively simple,
Okay.
often based on a single indicator. But real-world traders often combine multiple indicators.
Right, to create more nuanced signals.
Exactly.
Yeah.
So it's about finding that sweet spot
Okay.
where a rule is complex enough to capture real market patterns,
Yeah.
but not so complex that it starts overfitting to random noise.
So you don't want it to be too simple,
Right.
but you also don't want it to be too complicated.
Exactly. It's a delicate balance.
So how do we find that balance?
Well, that's where data mining can really shine.
Okay.
We can use it to help us optimize rule complexity.
Okay.
Aronson talks about techniques like genetic algorithms.
Genetic algorithms.
Yeah.
What are those?
They're inspired by natural selection.
Oh, wow, that sounds pretty high tech.
It is. It's cutting-edge stuff.
Okay, but like how does it work?
The basic idea is that you test thousands of variations of a trading rule,
Okay.
and then you breed the most successful ones together.
You breed them.
Well, not literally, but you get the idea.
Okay.
You combine the elements of the best performers
Okay.
to create even better offspring.
So you're like evolving trading rules over multiple generations.
Exactly. It's a really powerful way to explore a vast number of possibilities.
Wow. And you're letting the data guide you towards the most promising strategies.
Precisely. You're not just relying on your intuition or your gut feeling.
Okay, I'm starting to see how this all fits together.
Yeah.
We start with a scientific mindset.
Right.
We define objective rules.
Yeah.
We use data mining carefully.
Uh-huh.
And then we explore more complex strategies.
Exactly.
It's like building a house.
Okay.
You need a solid foundation before you can start adding all the fancy features.
I love that analogy. It's so true.
Okay, so we've got the technical side of things.
Right.
But we also can't forget about the human element.
Absolutely. That's crucial.
Even with the best trading system in the world,
Yeah.
you need the discipline to actually stick to your plan
Right.
and to manage your emotions.
Couldn't agree more.
And that can be really tough.
Oh, it is. It's one of the biggest challenges in trading.
I know from personal experience that like fear and greed,
Yeah.
they can really mess with your decision making.
Big time.
You mentioned that Aronson talks about some of the psychological biases that traders face.
He does.
Can you tell me more about that?
Sure. So he goes into quite a bit of detail in the book.
Okay.
But one of the biggest culprits is overconfidence bias.
Overconfidence bias.
It's that feeling of like, I've got this figured out.
Right.
I can't lose,
Yeah.
which can lead to taking on way too much risk.
Ugh. Yeah, I've definitely been there.
It's easy to fall into that trap, especially when you have a few winning trades in a row. It's like you suddenly think you're invincible.
Exactly.
Yeah.
And then the market humbles you real quick.
Oh, yeah.
Aronson actually suggests keeping a detailed trading journal
Okay.
to track your trades and your thought processes.
That's interesting.
It can really help you spot those moments when overconfidence might be creeping in.
So you can catch yourself before you make a big mistake.
Exactly.
Okay, what other biases do we need to watch out for? Well, another big one, especially for technical analysts,
Yeah.
is confirmation bias.
Confirmation bias.
This is the tendency to seek out information that confirms your existing beliefs
Okay.
and to ignore anything that contradicts them.
So like if you've convinced yourself that a certain pattern is going to play out,
Yeah,
you might only focus on the data that supports that view.
exactly. And you might ignore any warning signs.
That's dangerous.
It is. It's
Yeah.
like you've already decided what you want to believe.
Right.
And then you just filter all the information through that lens.
So how do we avoid that?
Well, Aronson suggests actively seeking out dissenting opinions,
Okay.
reading analyses from people who disagree with you.
That can be tough.
It can be, but it's a really good way to challenge your assumptions.
Like to make sure you're not fooling yourself.
Exactly. It's like getting a second opinion from a doctor.
Yeah, sometimes you need that outside perspective.
You do.
Okay, so confirmation bias, that's a big one.
It is.
Any other biases we should be aware of?
Yeah. The last one I'll mention is called the availability heuristic.
The availability heuristic.
Okay. This is where we tend to overestimate the likelihood of events that are easily recalled,
Okay.
usually because they were vivid or recent.
So like after a big market crash,
Yeah,
people might become overly fearful,
exactly.
even though historically those crashes are pretty rare.
Right. It's easy to get spooked by those dramatic events.
For sure.
But we need to remember that the market has a long history of ups and downs.
Right. It always bounces back eventually.
It does.
Mhm.
And Aronson suggests studying market history
Okay.
and understanding the statistical probabilities of different outcomes
Okay.
to kind of put those fears in perspective.
So it's all about taking a long-term view
Yes,
and not letting those short-term events derail your plan.
exactly.
It sounds like Aronson is really advocating for a mindset shift
He is.
in how we approach technical analysis.
Absolutely.
He wants to move it away from gut feelings and speculation
Right.
and towards a more rigorous, evidence-based approach.
Exactly. It's about treating technical analysis like a science.
I like that.
Constantly testing, refining, evolving.
So it's not about finding some magic formula.
No.
It's about developing a process,
Yes.
a framework for making better decisions.
I couldn't have said it better myself.
This has been a really eye-opening conversation.
Good. I'm glad to hear that.
But I have to admit, even with a more scientific approach,
Yeah.
it still feels like there's a lot of uncertainty in the market.
There is. There's no getting around that.
So how do we deal with that?
That's a great question.
Like, how do we actually make decisions when we know there are no guarantees?
Well, that's something that Aronson tackles head on in his book.
Okay.
And it gets to the heart of what it means to be a successful trader.
Okay, let's dive into that then.
Absolutely. He argues that, like, successful trading, it's not just about finding the perfect entry or exit point.
Okay.
It's also about managing risk.
Okay, that makes sense.
Oh.
You can't really control a market, but you can control how much you're risking on any given trade.
Exactly. And that's where this whole evidence-based approach really comes in.
Okay, so how does that play into it?
It's all about probabilities.
Probabilities, okay.
I mean, no trading system is going to be right 100% of the time.
Right,
But if you have a system with an edge,
okay,
even a small one,
yeah.
and you manage your risk carefully, you can come out ahead in the long run.
So it's not about, like, finding a crystal ball or anything.
No,
It's more about, like, tilting the odds in your favor.
exactly. It's a numbers game.
Okay, so how do we do that? How do we even figure out if a system has an edge in the first place?
That goes back to the scientific method we were talking about earlier.
Okay,
You need to backtest your system on historical data.
backtesting. Okay,
Not just any data.
okay.
You need to use data that's representative of the market conditions you expect to trade in.
So you can't just, like, test a trend-following system
Right.
on a period where the market was going straight up.
Right. Exactly. You need to see how it performs in different market environments.
Oh.
Bull markets, bear markets, sideways markets.
Right, you need to put it through the ringer.
You do. And you also need to be aware of something called survivorship bias.
Survivorship bias.
Mm-hmm.
Okay, what's that?
It's the tendency for, like, data sets to only include companies or systems that have survived.
Okay.
So you might be missing crucial information about the ones that failed.
Oh, so it's like only reading the success stories.
Exactly. You're not getting the full picture.
Right. You need to see the failures too.
You do.
Okay, so once you've backtested a system
Yeah.
and you think it might have an edge,
Okay.
then how do you actually manage risk? Like, what does that look like in practice?
One key concept is position sizing.
Position sizing. Okay.
This is how much capital you allocate to each trade.
Okay.
You never want to risk too much on any one idea.
Right. No matter how confident you feel.
Exactly. Even if you think you found the holy grail of trading systems,
Yeah.
you don't want to go all in.
Okay, so diversification is important.
It's crucial. You want to spread your risk across multiple trades
Okay.
and potentially even multiple systems.
Right. Don't put all your eggs in one basket.
Exactly. And another key element of risk management is having a plan for what you'll do if a trade goes against you.
Okay.
This is called your stop loss.
Stop loss.
It's a predetermined price level
Okay.
at which you'll exit the trade to limit your losses.
So you're not just, like, letting your emotions take over
Right.
and hoping for the best.
Exactly. Having a stop loss helps you take the emotion out of the equation.
Okay.
It's a rule you set in advance.
Right.
So you're less likely to make impulsive decisions in the heat of the moment.
That makes a lot of sense.
Yeah.
It's like having a safety net
Yeah.
so you don't fall too far.
Exactly.
But isn't it hard to, like, actually stick to those rules
It can be.
when you're seeing your money disappear?
Oh, it is. It's definitely not easy.
Yeah, it takes a lot of discipline.
It does.
Yes.
And that's why trading psychology is so important.
Trading psychology.
Okay.
Yeah.
You need to develop the discipline to follow your plan even when it's painful.
Right.
And you need to be realistic about the fact that you're going to have losing trades.
Okay, nobody's perfect.
Nobody is. It's part of the game.
It's like being an athlete.
Yep.
You need to train your mind just as much as you train your body.
That's a great analogy.
So it's not just about the charts and the numbers.
Nice.
It's also about understanding yourself,
Yeah.
your strengths, your weaknesses, how you react under pressure.
Exactly. It's about taking a holistic approach to trading,
Okay.
combining technical analysis with risk management and a strong psychological foundation.
This has been a really fascinating deep dive. We've covered so much ground,
We have.
from the dangers of subjective technical analysis
Right.
to the power of data mining
Yeah,
and the importance of managing risk.
absolutely.
But I think like the biggest takeaway for me
Yeah.
is that this evidence-based approach,
Okay.
it's not just about like finding winning trades.
Yeah.
It's about developing a more rigorous, disciplined,
Yeah.
and ultimately more successful approach to the market.
I couldn't agree more. It's a journey of continuous learning and improvement.
And it's one that anyone can embark on,
Absolutely.
no matter their level of experience.
Exactly.
Well said. Well, this has been an awesome conversation.
Yeah, it has.
Thank you so much for sharing your insights and expertise with us today.
My pleasure.
And to our listeners, thanks for joining us on this deep dive.
Yeah, thanks for listening.
We hope you learned something new and valuable.
Hopefully.
Remember, the markets are constantly evolving, so stay curious, keep learning, and never stop testing your assumptions.
Couldn't have said it better myself.
Until next time, happy trading.
So how do we deal with all this uncertainty? How do we make decisions when we know there are no guarantees?
That's a question, isn't it?
Hmm.
And Aronson actually, he really tackles this head on.
Okay.
He does successful trading. It's not just about, nailing the entry and exit.
Right.
It's also about managing risk. Okay, that makes sense. I mean, you can't control what the market's going to do.
Nope.
But you can control how much you're risking.
Exactly. And that's where this evidence-based approach comes in.
Okay, so how so?
Well, it all comes down to probabilities.
Probabilities, okay?
No system's going to be right 100% of the time, right?
Of course.
But if you have a system, even with a small edge,
Okay.
if you manage your risk, right, you can still come out ahead over time.
So it's not about finding a crystal ball.
Nope.
It's about tilting the odds.
Exactly.
Okay, but how do we do that? How do we even know if a system has an edge?
Goes back to that scientific method.
Okay.
You got to backtest.
Backtest, okay.
But not on just any data.
Okay.
It's got to be data that makes sense for the conditions you're going to trade in.
So you can't test a trend-following system
Right.
when everything's just going up.
Exactly. You got to see how it does in different markets.
Okay.
Bull, bear, sideways, the whole 9 yards.
Really put it through its paces.
Right. Yeah. I got to watch out for something called survivorship bias.
Survivorship bias. What's that?
Well, it's like when a data set only shows the winners.
Okay.
You miss all the stuff that failed.
Ah, so it's like those stories you only hear about the successes.
Exactly. You don't get the whole picture.
Right. Got to see the losses too.
You do.
Okay, so you've backtested.
Yeah.
You think maybe you've got an edge.
Okay.
Now, how do we actually manage risk? Like, what does that look like?
Big one is position sizing.
Position sizing. Okay.
How much you put on each trade.
Okay.
Don't want to risk too much on one thing.
Right. Even if you think you've got it all figured out.
Exactly. Even if you think it's the holy grail,
Yeah.
don't go all in.
So diversification is key.
Super important. Spread that risk around.
Okay.
Multiple trades, even multiple systems.
Don't put all your eggs in one basket.
Right. And you also need a plan if things go south.
Like-
That's your stop loss.
Stop line.
You decide ahead of time.
Right.
Like if it hits this price, I'm out. Limits the damage.
So you're not just like holding on hoping.
Nope. Got to take the emotion out of it.
Makes sense.
Yeah,
Having a safety net.
exactly.
But is it hard to stick to that when you're watching your money go down?
Oh, it can be tough, for sure.
Yeah.
That's why the psychology of trading matters so much.
The psychology. Okay.
Got to be disciplined, follow the plan, even when it hurts,
Right.
and be honest, you're going to have losers.
Okay. Nobody's perfect.
Nope.
It's part of the game.
It's like being an athlete, right?
Yeah.
Got to train your mind just as much as your body.
Great analogy.
So it's not just about the charts.
Nope.
It's about knowing yourself, too.
Yeah. Your strengths, your weaknesses,
Yeah.
how you handle pressure.
It's the whole package.
Exactly.
Yeah,
A
that's it.
holistic approach.
This has been fantastic.
Glad you enjoyed it.
We've learned so much.
Oh, I have.
Subjective analysis, data mining, risk.
Old deal.
But for me, the big thing, this evidence-based approach, it's not just about winning trades.
Right.
It's about being smarter.
More disciplined and ultimately better traders.
Couldn't agree more. It's a journey.
A journey.
Constant learning, always improving.
And anyone can do it.
Right. Doesn't matter where you're starting.
This was awesome.
My pleasure.
Thanks for sharing your expertise.
Anytime.
And to everyone listening, thanks for joining us on this deep dive.
See ya.
We hope you found something valuable here.
Hopefully.
Markets are always changing, so stay curious, keep learning, and don't be afraid to question what you think you know.
Wise words.
Till next time, happy trading, everybody.